Welcome everybody here to our next webinar at JFD Brokers. Today's topic is the supreme. Now I talk wrong pronunciation of that wording. The supreme discipline of trading, portfolio trading. That's exactly the topic of today. We deal with portfolios. That's really something very important, very interesting, and you can learn a lot during this webinar. My name, Stefan Friedrichowski, as always, for those kind of webinars. A warm welcome in the name of JFD as well. Those are the one which make those webinars possible for everybody of us, and it's really cool to have you here today. Today is the 28th of February 2019. And I mentioned already the topic, portfolio trading. It's about having a couple of strategies, and the question is simple: how to select, how to allocate money. If you have the chance and possibility to have several strategies, then you immediately end in those kind of questions, and that's really quite important, how to diversify your strategies and how to allocate the right amount of money for a given strategy. As always, you will find the slides of the webinars already ready for download in the GoToWebinar control panel. And if you have any further questions or interest in later shown Excel sheets, no problem. Just drop me a note at s.friedrichowski@jfdbrokers.com, and I will immediately make it possible that you have access to those kind of slides and those kind of Excel sheets. Okay. Before we really start, you know the procedure. As always, I have to show that slide at least once during a webinar. It's our risk disclaimer, because we talk about trading, we talk about strategies, we talk about how to set up a portfolio, and later you will do maybe similar steps, maybe following things you have learned during those webinars. But of course, finally, as always, you are responsible for your own activities. I think that's self-explaining and has to be mentioned at least once during a webinar. Let's look a little bit more in detail. What are the topics of today? It will start with two things which I have shown in previous webinars. A little bit about what we present, the good equity curve. That's easy stuff, so to say. And we have to talk about how drawdowns add up if you add several strategies. So that is a quite cool question. And you see already, I wrote down 1 + 1 = 1.41. That sounds crazy. Still, I know what I'm writing here. So those two topics, what is a good equity and how to deal with several drawdowns if you overlap several strategies, that is more for introduction. But then we go really to portfolio trading, and even we start with that, the basic question: why going for portfolios and not to just create the next strategy? No. In order to create a portfolio, we need key figures of the individual strategies. And I will introduce, let's call it a concept, what kind of key figures you need in order to really have everything ready for creation of your own portfolio. Because there's some input needed. Not just want to say, okay, I diversify my trading, I have several strategies, and I go for all. No, we need input in order to really mathematically derive our portfolio allocation, and therefore we need those specific key figures to do the steps right. And then, of course, we really set up a portfolio, and now I need a base for data. And I will use strategies from JFD Invest. You might have heard about that there's a collection of several strategies available. Right now we have 11 strategies at JFD Invest, and finally what you can do there is you can follow those strategies, build your own portfolio, and so on and so forth. But that's not really the topic of today. I just want to have that as an input. I want to use the key figures of those strategies which I implemented at JFD Invest. I use exactly those strategies, those key figures as input, and then out of those we create that kind of portfolio. But I mention it once again. You can do it with any kind of strategy, your own, other people's strategy. You have heard about it. You follow maybe something else. So you can do everything, not only with JFD Invest strategies, you can do it with any strategies, at least if you can create the right input key figures, and then you can follow exactly the same steps, and finally you can use exactly the same Excel sheets I will later show, and you just have to replace the numbers within that kind of Excel sheet. Okay, once again the basic question. Why? Why are we going for portfolio trading? Or what do I mean with portfolio trading? Portfolio trading, I mean here is simply that we have a couple of strategies, and finally we want to use them all, or maybe a subset of those, but still we want to have high profits, we want to have low drawdowns. But now is the question how to select. Just give each strategy €1,000 and it should do its job? No, that would be a little bit too simple. So we want to do it professionally. But why? The first is obvious: diversification. I think that is not only a word, it's a quite important subject that we know. If we put all our eggs in one basket, that means no, that's not a good idea. And I mean, if you have several, we should use them. Diversification is key for professional portfolio, is key for professional investment. And as with your own strategies, if you want to overlap those, you're doing a really cool job and you act as being a portfolio manager. The good thing is finally that we have a better adjustment to different market phases due to totally different strategies, at least if those strategies are really more or less independent. So I'm not talking about two long-only strategies, one long-only strategy on S&P 500 and one long-only strategy on DAX, for example. Okay, it's not exactly the same market, but still those two strategies would highly correlate in their results, at least if they act on same time frames. So that is not a good diversification. With better adjustment to different market phases, I mean simply, I even cannot define market phases, to be honest. And you hear me laughing because it's really quite difficult, at least to do it as we speak. Looking back into the history, then we can say, okay, that was a sideways market. Yeah, that's good. That was a trendy market. Good. But to be in place exactly in time and to know what kind of phase we have, that's really difficult. But if we have different strategies, they will react on different phases. And if we have them all together, then we are better adjusted. Finally, that gives us more smooth equity curves, which is quite elegant. That's exactly what we want, that we have more smooth equities and we have the possibility to reduce any drawdown. Or we can take our money, let's say twice, or we can, by reducing the overall drawdown, we can maybe increase the risk in total. Maybe. Let's talk about that. But at least principally, if we add up, if we overlap different strategies, that will that results in a reduction of drawdown, and That's first and exactly what we try to achieve. Finally, and I wrote it in brackets here, we have a more relaxed trading, because we don't have to think about the last trade or the just ongoing trade, big trade, one symbol, and we hope that overnight we become rich. That's exactly what we don't want to achieve. We want to have a more relaxed situation, and if we diversify in terms of different symbols, different strategies, then we get exactly what we want to achieve. Before we go into the portfolio, I mentioned that I have two topics before we really start. That is a slide I think I have used in a previous webinar, whenever exactly. I put it on the table here because if we talk about portfolios, we talk about equity curves, and the question is always, how can we call an equity a good one? Okay, it should go north, no question. We want to have a good slope, no question. But finally, look to those four different equity lines, and you may answer already here in the chat which one you like most. And equity 1, 2, 3, or 4. Of course, let's look a little bit more in detail. We see that the red equity, the equity 1, is outperforming all the others, definitely. It's earning within a little bit more than 1,000 trades, 4,000 euros. It has the best slope. So that is a top performer in terms of profit. That's obvious. And the other three have less profits. But, and I get already first answers, and you are totally right, and I switch already to my next slide with the final answer. So equity 2 is the best one. Why? Profit is not all. We have to think about profit in relation to drawdown. Look once again to the red one. We have 4,000 euros profit. And in between, we have drawdowns that are phases, for example, from here to here, or from here to here. Those drawdowns might be in the order of 300 or 400 euros. Looking for equity number 2, it's hard to see any drawdown. There are some, but maybe 10 or 20 euros, not more. So if you now compare the overall profit, or better to say the slope of the equity, with the drawdown, then we easily can realize a good key figure, profit divided by drawdown, in order to answer the question, which equity curve is the best. And still, that is not the final answer. You might have other preferences in order to call something the best. And honestly, there are 1,000 ways to describe that. You might have other boundary conditions in mind to define that. But for up to now, we can live with a very simple key figure and this is profit divided by drawdown, because that is something like the risk-reward ratio. Not in the sense of we have a trade, we have a stop loss, and we place a take profit 3 times away from stop loss. No, that would be the normal definition of risk-reward ratio. Here it's meant for a strategy. Our reward is a profit, and our risk is a drawdown. And those key figures divided by each other is a very good key figure in order to describe equities and in order to say which one is really good. We will use that in a few minutes just for the first overview about 11 strategies in order to answer the question, which one's the best. You will see we have much more boundary conditions to be involved later, but it's good to have the answer for the question which equity curve is the best. The other principal question is what really happens if we overlap two equity curves? And so overlap means firsthand we just add them. Later we will give them weights first, but let's start just by adding up two equities. And if we do exactly stuff like that, then there's a very simple equation. And that equation is written here. The drawdown of the combined equity is always less or equal than the sum of the individual drawdowns of those given strategies. Think about it a little bit. That's really good to know. So the worst case, which might happen, is that they simply add up. But that's really the worst case. In totally uncorrelated cases, and I will have an example in a minute, then it's a little bit different. So we will never have really a drawdown which is the sum of the individual drawdowns. No. If I assume that drawdown 1 and drawdown 2 for the two equities we want to overlap, those drawdowns in numbers are the same, then our combined drawdown is just the single one multiplied with the square root of 2. Therefore, this 1.41. And that's really important. So if you go further in down that road, it means if we add equity curves of uncorrelated equities, then we can sum the power of 2 sums of the individual drawdowns, and finally then we create the square root of that sum. So that's really good. So it's like 1 power 2 plus 1 power 2 and then the square root. Or if we have individual other numbers, okay, we can always use the square sum, and then finally from the sum we calculate the square root. Mathematically, that's only true for totally uncorrelated equities. The good thing is that we have exactly those. Not absolutely uncorrelated, but we can make use out of that formula later, because that enables us to have higher returns with combined portfolios. I wrote it here already that later I will simply introduce a security factor of 2, just to be on the safe side. So still, the assumption would be totally uncorrelated. Since that is not proven, I will later use just a factor of 2 for the summed drawdown, just for security, to have some buffer for anything which we cannot predict that quite well. Let's have a look to the formula once again, or to have it a little bit more visual. So think about the following here. I have two rows of numbers. Two columns. One is A and one is B, and I just have random numbers here between -1 and +1. So those might represent something like the daily profit of a strategy or something like that. Those would be the blue and the red curve here. And now I add those up. That results in the yellow curve. And the good thing is, if I calculate the standard deviation of a single line, it would be 0.6. For the other, 0.6 about. If I do the same for the added up equity, it's 0.86. So the ratio is now 1.44. It's close to square root. The same is true if you go for drawdowns. I have created here in total 3 equity curves. The red, the blue, and then they added up. So the sum of the both. And we can do exactly what we normally do with equities of trading. We can calculate the drawdown. And for example, if we look for the drawdown of the red curve, it's about 4. And we have a drawdown within our blue, which is about even 5. And now look to the combined equity. It's definitely not 4 plus 5, meaning 9. No, in this practical example, it would be still something in the order of 5. That's brilliant. That's good that a combined equity has not the sum of the individual drawdowns. That's really good. That is a principal advantage of any portfolio of uncorrelated trading strategies. If you have that as an input, then your drawdown will always be smaller if you overlap those individual strategies. So that's really a very important input for our portfolio's allocation. That is the starting point. We know how to deal with drawdowns, and we know how to add up drawdowns for individual strategies. We know how we can judge equities. That's good as well. So we are prepared. But now is the question, what kind of input do we really need from individual trading strategies? So what is what is needed? In total, in order to set up a portfolio, okay, the first thing is we need a couple of profitable trading strategies. And I mean profitable. Of course, just with diversification, we cannot turn a couple of unprofitable trading strategies into a profitable portfolio strategy. Of course, that's not possible. So we need profitable trading strategies as an input. And the more, the better. That's in principle right. Later, I will use the numbers out of the JFD Invest platform so that we have real numbers as an input for that portfolio creation. Of course, we need the individual equity curves of those individual strategies. That's important. To have really the complete curve would be ideal, but in most cases, only in those, if you have, they are completely by your own, then you might have access to the complete equities. But at least what we try to use here is the monthly return table of those individual strategies. So definitely we need those, but then we might lose some information. The detailed information within 1 month. There might be huge losses, and later the months turned to be a green one, so a profitable one once again. So if we only have the monthly return table as input for historical equities, then we need 2 additional key figures, and both are very important. And you realize already that I emphasize it a little bit more here verbally, because it's important to have both. Both drawdowns are equally important finally. We need the drawdown of the balance, and we need the drawdown of the equity. Okay, maybe you have a question mark right now in your head. What is Stefan talking about? Drawdown of balance, drawdown of equity. There's a difference. And the difference are the floating losses. Drawdown of a balance curve. Balance curve from a trading strategy is your account always with closed trades. So your balance curve will make jumps to the north or to the south only if the trade is completed, is executed, is finished, closed. But what in between? It might be that you open a trade and then the trade goes into the minus, goes more into minus, even more into minus. So you might have floating losses. That's the normal standard name for those losses with open trades. So floating losses are the open trades. And we might have high numbers for floating losses, and still we have to to suffer them. So we have later, if we trade that kind of strategies, it's important that we know in advance that there might be floating losses which are much higher than you are willing to accept. If so, we have to react. So both is important. Drawdown based on balance, drawdown based on equity, meaning floating losses. And both numbers I will illustrate in a minute a little bit more when it comes to JFD Invest and our input. Then there's another big thing we have to consider. Think about trading strategy. We have an account. The account might be a 1K account. Good. That 1K account is trading several instruments, but always that trading account is trading 0.01 lot. So the minimum lot size. Good. And now we want to scale that account. But what does it mean? Normally, if you have a 1K account and we want to scale it to a 1.5K account, so not to invest 1,000 euro into that strategy, we want to invest 1,500 euro into exactly that strategy. Or think about your own trading. You go for 1.5 times the original size. What do you do with your lots? So with your lot size, can you multiply your 0.01 trade with 1.5? Of course not. So there's a minimum lot size and a minimum step size, which is 0.01 for most of the Forex pairs. Just as an example, for DAX, it might be a little bit different, or any other instrument. So that kind of scaling is not that easy as we might think. And originally, when I thought about doing a webinar and to deal with portfolios, everything looks quite easy, because you think everything can be adjusted, you can have multipliers, whatever you want, but that's not right. If we are not talking about several hundred K euros, we want to invest in a couple of strategies, because if we have really high numbers for our investment account, then that kind of topic here is not that important. But assuming that we are talking about maybe 5K, 10K, yes, then that topic is very important, because we cannot really scale with any floating number. If we are already trading minimum lot size, the only thing we can do is we can go from a 1K account to a 2K account, and then we not any longer trade 0.01 lot, now we trade 0.02 lot. In between, we have no choice. There's no chance. Therefore, this is very important that we have the minimum lot size in mind as well. Scaling can be much more difficult in this case than you originally might think. Let's first look how I get my input. How I get my input for those numbers, and let's revisit the topic of equity balance and drawdowns. Because if we go here for some specific strategies, then it will be hopefully more obvious. Let's start with the strategy, for example, gold mine. So that is the input I take here from exactly that kind of web page. You see already, here's the monthly return table. That is one input I have copied into an Excel sheet, and then let's look for the other key figures. We have one number here, which is the equity balance deviation. That is the maximum floating loss which has ever occurred within that trading history here. So we know now that 5.8% floating losses is possible for that kind of strategy, at least during the last, 14, 15 months, that was the highest number. But now that's the one part. The other part is, of course, we have to look for the maximum drawdown as well. The maximum drawdown for that strategy here is from this point, 6,162 euros, down to here, 5,000 and something. That is a drawdown based on balance. And we need both. We need that equity balance deviation out of floating losses as being one maximum number, and we need the overall drawdown as well. You may think about that a little bit different. Finally, if we would have the real equity, including all, then we could use that drawdown out of that curve as well. But since we don't have access to those kind of numbers, I separate the two in drawdown based on balance and drawdown based on equity balance deviation. And you see the two numbers here. One is 5.8 and the other one, I don't have it by hand, but it's 10% and a little bit more, maybe 12% here. Both numbers I put into consideration for our portfolio calculation. The other topic I mentioned, we have to think about minimum lot size. Let's, I need access to that one. Sorry, I forgot that I need this one, so I have to log in order to see the closed trades. Just a second, then we have it. Because we have to look what is the minimum investment sum for such a strategy. And the minimum investment, think once again about my example. We have a 1000K strategy, and the strategy is trading 0.01 lot, and we cannot scale it with a factor of 1.4 or 1.3, for example. First, let's have a look to closed trades. Closed trades, why? I want to have a look to what is traded. And if you go through that kind of strategy here, I know for sure that it's always 0.01 lot. That's the trade size of that strategy. What does it mean? In principle, JFD wrote down here minimum investment 500 euro. That's okay. You can go for that strategy with 500 euros. But thinking about that scaling of a single strategy, no. Then the correct answer would be we need 6K. Because with 6K, the strategy is trading 0.01 lot. So whenever we want to double the 0.01 lot, it would mean we need 12K for the same strategy. And in order to have the numbers of drawdown in percentage right, we can only go for those kind of integer multipliers. So we can go for 6K or times 2, times 3, and so on. And the minimum sum would be exactly 6K. So that's important. You see, portfolios, to create portfolios for millions or billions of euros, that's easy. But to create portfolios for smaller amount of money, like even 10K is small, or 5K, it's not that easy, because we cannot scale like we originally might think about that topic. So Those are the inputs we need. If you have that kind of input, then we can start. So let's have a look to the input. Finally, so we have it here, and that's a collection of numbers. Oops. I have no idea why my screen went black. I'm not sure whether it was for you as well. Anyhow, the screen is back. And still, I think everything is working right. So what I have here is exactly the collection of all those strategies. And now the game starts here. I mentioned if you want to do it with your own trading strategies, you just have to replace those numbers by your own strategies or whatever input you use for different kind of strategies. If you have those numbers, you can use everything exactly what I present here. So in my case, I collected all the numbers from 11 strategies. I have the monthly return tables transposed here into that kind of list. And then I have always a number, equity balance deviation, drawdown balance, and finally I adjusted everything to minimum investment sum based on lot size, and I have the input of the web page as well. Later we will use always the higher number of the two, because that's the one we should really use for that kind of scaling. So once again, we can not scale a strategy which has minimum 6,000 to a 7,000 euro strategy, because we have not the right multiplier for that. So that's the first. That is the basic input, and you just have to replace those numbers and everything is good. But now first question, which of those strategies is doing the best job? So let me summarize the data here. And the first thing, let me go for that kind of zoom here. I just translate the monthly return table into a chart graph, a bear chart. No, that was not a good idea. Let's do it for an equity. So that's the one here on the right-hand side. And I have to make a comment here. I did something mathematically incorrect. In the complete Excel sheet, I go for sum up of percentage changes, which is not correct. I know that. No question. So if you have an increase of 10% and then a second increase of 10%, that is not 20%. I know. But let's keep that as a reserve for anything unforeseen. That this is not exactly correct. So I did really summing up. I did it here by summing up the percentage values. That's good to know that we have a little bit in reserve. And then, best equity or best is definitely Hyperion, 80% growth, followed by Galileo. Remember, was it right just to look for profits? No. One step further, what I did. In order to answer the question first, which strategy is the best? What I did is, first, I used two kind of summing up of drawdowns. One, I use exactly that square root behavior. That's one column here. And the other has been, I simply looked for the maximum number of the two. Anyhow, it doesn't really change the big picture. What I calculated finally has been, so the sum of all profits divided by those drawdowns. And now you see, okay, Hyperion, which has been with close to 80%, which was really the outperforming strategy here, is not anymore the best one. No. Now it's Archimedes. This so-called, or what I call now risk-reward ratio, the best is here. That's important that we realize going for highest profits is not always the best. It's the combination of profit and drawdown. And if we want to create the portfolio, we need both. So it's good that we not simply look for the high performer, because then we don't need a portfolio. If you just look for the maximum profits, okay, answer right, Hyperion. The only downside would be you would definitely, to be on the safe side, you need 38K for that strategy and follow that. Okay, and then you get the highest profits. But that's not the portfolio we have in mind. We want to have it balanced, and we want to take drawdowns into account as well. Okay, then we can really start creating our job as portfolio manager. We only need 2 additional numbers. Let me introduce those 2 first, and then I come to my final step. We just need 2 numbers. What is the amount of capital for our portfolio account? And we can set up an allowed drawdown, because that might change the picture. If we go for a maximum drawdown of 10% or a maximum drawdown of 20 or 50%. And so it's already here. We have to think about our preferences. I know that everybody would like to go for a drawdown of 0. Then trading is not the right answer. But so we need to set up here level. Or sometimes I use the question, how much money are you willing to lose? Always a very strange question. If you talk about trading, you talk about profits. And one of my first question is, how much money are you willing to lose? What's important? Very important question when we talk in general about trading. So if you have those 2 numbers, then we have one single remaining question. How to allocate the money for individual strategies in order to achieve the highest profits. You might have other things as boundary conditions as well in mind. Maybe you want to change to rephrase that kind of question. You may think, okay, I have a target and the target profit is 10%, and now you want to minimize the drawdown. As always, when it comes to optimization, the answer is not straightforward, because we have to define our boundaries and how to measure. It's the same then you have a navigation system and you want to come from point A to point B. What is the best route? The answer, I don't know. It depends on what you call best. For one, it might be the shortest. For the other, the fastest. The next one, only public transport, whatever. So there's no single straight answer what is route from A to B is the best. So having those numbers, we can go into the final step of creating that portfolio. And now I go here for the next one. And now it comes maybe a little bit complicated. I hope you can still follow. So you know already the left-hand side here. That's the input table with all the key figures we need for setting up the portfolio. What's new now? The minimum allocation sum for an individual strategy. You would have to do the same thing for any other kind of strategy. And I assume if you have different strategies, you might have a strategy which can be traded with 1K, and there are other strategies. They need definitely, for example, 10K, otherwise you cannot trade them. So we need that minimum allocation for a single strategy. Okay, understood. So that part we know, that's the input. I make already one remark. I changed the number for Archimedes of equity balance deviation. Originally it was 4.52, changed it to 15. Reason? That strategy has much shorter history. That's not that good, that we don't have numbers, more numbers here available. Therefore, I want to be on the safe side. That's the only reason why I increased that. But now let's come to the funny side here. That is part of the portfolio setting. And, unfortunately, I moved too far. So now I'm back. So you see already, and we have the overall growth, but let's come to the input. So we have here an investment sum. I use 100K. I have later other numbers, no problem. Then I set up a maximum allowed drawdown. Very good. And now I can change the numbers. Let me start with zeros. So now we don't have any profit. Let's start with Galileo. And we can only use multipliers. So we use a multiplier 1, and then we have already some results like here. So you see we have profits in total after a little bit more than 1 year of 3%. Okay, so why is it that low? Yeah, we have only invested 5K. And now we can switch on any other strategy here as well. Just having multipliers, and those multipliers go as multipliers on the minimum investment sum. And now you see it's already getting smooth. It's nice. We have already 0.5% growth per month, which is about 6% a year. That's already good. And we can, what do we have else? Now we have invested 34K. We have a drawdown of 4%, and that drawdown is calculated exactly with that kind of square root behavior with a security factor of 2. So far, so good. So now you might change numbers here. You go for higher values for this strategy and higher values for that strategy. Now we have already invested 91K. Good. And let me add up here a little bit more. Now, oops, everything is red because we are now over invested. So our invested sum is 101K. And that's not good. Therefore, the number is red. The profit is set to 0. You may think Stefan has something in mind what he finally wants to do. Because I have calculated the profit now to 0 means I will later use the so-called solver, an optimization tool out of Excel. So that is doing exactly what we're doing here. Manually, we change allocation and look for highest monthly profit. That's what we are doing here right now. If I change numbers and now I go for 6, now I'm once again over invested, not valid. That's one possibility which might happen here, or there might be other things happen. Let me create such a case. And the other case would be, I do it that way. If I go for maximum drawdown of 10%, then you see it's once again turning down to 0, the profit. Reason, we have actually 11, that's exceeding the 10, and therefore we have no further result. So you see, you can play around manually by using those multipliers as input, and that creates a strategy, but we can even do it better, just using directly Excel. Let's use it. So that's really, it's the same Excel sheet, and the only thing, and I always start with zeros here, and then we use a technique which is called solver. Solver within Excel. Solver is a built-in optimization tool in Excel, and it's doing the following. So we select one cell, which is U3 here in this case, and that is the profit per month. And that one we want to maximize by applying the following change of cells. And those cells are exactly the multipliers for our individual strategies. Since we know that we cannot change those numbers with floating numbers, so not 1.5 or 1.3, only in integer values, I use a trick. And the trick was I use that cell and then I use the integer command within Excel. So that's the trick, that I don't still have those integer behavior for multiplying by allocated sum, and then we can do it. So we want to maximize our profit following the boundary conditions of investment sum of 100k and allowed drawdown of 25%. So therefore we need those boundary conditions here, and then we can start optimization. And that's all we have to do. You may think, hey, nothing is, I don't see anything. So computer is working. In the left-hand corner, you see it's already achieving 0.4% growth, and number changes and changes and changes. It will take half a minute, then we get a result. One side remark to optimization and using the solver. That is not a so-called deterministic process. Means you start the process twice and you get not the same result. Reason is it's not an exact solution. It's always close to that. And now it's done. We are ready. Portfolio is created. And you see the best way to allocate our 100k in order to achieve highest profit under the boundary condition of maximum drawdown of 25% is going with 50k for Galileo, 3k for Archimedes, and so on and so forth. You read the numbers. That's cool. That's the best balanced behavior we can achieve for a given investment sum and a given drawdown. We can use other numbers as input, other strategies as input. You can always use exactly the same kind of formula and create your portfolio allocation. Everything is done more or less automatically. Still, you might do it by your own. Just saying, okay, I like that strategy, that looks promising for the near future, for whatever reason. Of course, you're welcome with that kind of idea as well. But doing it completely mathematically would be this behavior. Later, I will just introduce one other boundary condition, but I show you already the results for other investment sums. So here we go. So those are already, I've done the calculation. So I used accounts from 100k down to 5k in 2 drawdown steps. One has been maximum drawdown of 10% and the other one of 25%. And then you see how to allocate for those kind of strategies. I repeat myself. If you have other input, other strategies, totally your own strategies, you can simply do the same, and you get quite good balanced portfolio, looking for drawdown, achieving highest profits. The normal behavior you can realize here by your own. The higher your account, the more profits you can generate. Why? Because those kind of boundary conditions, you know that Hyperion is only applicable with 38k. For nearly all of those kind of accounts, we cannot use even that kind of strategy. And then we have the problem with drawdown, and therefore Hyperion was out of the game here in that kind of behavior. If you go further up the road to 1 million accounts, no problem. And even earlier, that strategy would be incorporated as well. So there are several ways for setting up your portfolio. You can do it strictly mathematically, you can do it strictly manually, and you can try to use, let's say, a little bit of a combination of both. So looking to those numbers or those potential portfolio settings here, what you might realize is that, for example, if you go here, then there's a single strategy which looks over pronounced, so to say. So half of our money would go into a single strategy. Maybe we should use an additional boundary for that. And that's what I call go for a little bit more balanced. And what does it mean to have an additional boundary condition? It's quite easy if you have it already within your Excel. I have to open one other Excel sheet, and I will show you how to add an additional boundary condition in this case. And that's here. No, just a second. It's not here. It's here. So that Excel sheet is called max proportion. So what I did here is the following. I set up a number of 25%, and that should be the maximum percentage of a single account within the portfolio. So just to have it more diversified, not in the way that, as I showed previously here, that 50K are in one strategy, so half of our money would go into one strategy. No. So now I set that limit. And since you realize that whenever I violate a boundary condition, I simply set my profit to zero, I use here the same kind of formula. So whenever a specific proportion of a given strategy is exceeding that value, I turn my profit to zero. So just as an example, if I go here, for example, for 20, and then we immediately go down. No. Then we have it a little bit more balanced. And that kind of behavior is a good thing as well. And we'll see the results for those more balanced portfolios in the following table here. Now you see we don't have any more 50K in a single strategy. You see, what I present here is on the one hand final results, and on the other hand just a concept of how to set up your own portfolio, not only for JFD Invest, just for your own trading strategies. That we do diversification is good, that we knew already before, but to do it exactly right, that's the kind of methodology which is behind those sheets and those Excel formulas. Because now we can really go mathematically, strictly forward, and no question, no gut feeling, nothing. It's just pure math which is behind here. And then we can create those portfolios. And of course, you see, if we lower our investment sum, then we cannot go for those high risk strategies, high volume strategies anymore. And we switch to others, which is good. But we can still achieve high profits. And I hope you can do the same with your strategies or other input you have in mind with other strategies. So in a nutshell, of course, portfolios have enormous potential because they are intrinsic diversified and they offer new opportunities. So what I introduced here was two things: the methodology of how to set up a portfolio, but on the other hand, you have ready portfolios to be traded, for example, at JFD Invest. You can do this exactly same steps with your own strategies and with or other people's strategies, which you would like to combine in a more professional manner. And finally, of course, you can do things like I do here with the JFD Invest strategies and achieve good profits, as you know, within my JFD Invest account. You may have seen those in other webinars. I can just show the result of what I'm doing here. Again, although this is not normally the topic of today's webinar. But here we go. That's my JFD Invest account, a well-balanced account, going straight north, not absolutely straight, but quite well. So that's a portfolio out of JFD Invest Strategies, and it's doing really a good job. If you have interest in those Excel sheets, slides, no problem. Just drop me a note via email. Unfortunately, I cannot upload those Excel sheets here directly. It's not possible, but just drop me a note and I make sure that you have access to those as well. I hope you enjoyed the webinar. If you have further questions, you can send me an email as well. And we might even Skype if you like, and get in more close contact. I'm open for everything like that. Enjoy the day, enjoy the evening, and hopefully see you at the next webinar. Then we talk, I can announce it already, then we talk about an interesting trading setup once again. And we will talk about sideward markets, which is nice that normally we talk about trending markets. Now we talk about sideward markets and how to gain money out of that. That will be cool. You will see. So stay tuned and see you next month. Bye bye. Ciao.